Hey there, it's Casey Dimon here with TaxSaleAcademy.com. Thank you so much for joining me on today's video. Today I've got a quick tip that I wanted to share with you that will help you on your tax sale research. So as tax sale investors, we are always looking to get the best deal, right? And with tax sale investing, there are so many incredible deals that are sold on a daily basis. It usually just comes down to finding the deal that fits your specific investment objectives. But at the core of tax sale investing is the very purpose of the tax sale itself. We must remember that these properties are tax defaulted properties. That means that the owner of the property could not or did not want to pay the taxes on those properties. So when we compare a list of available properties on a tax sale list to any other type of list available, like a foreclosure list or simply Zillow listings, for example, you must understand that there is a substantially higher concentration of properties that you'll want to avoid when you look at that tax sale list, when you compare it to anything else. So in today's video, I want to discuss 3 different types of properties that you should probably run from, especially if you're a new tax sale investor. Now, it's not to say that you cannot make money in some of these properties, but as a new investor, you should probably run from these, at least starting out, until you gain some experience. And truth be told, most veterans should probably steer clear of these properties as well, unless they're ready to put forth quite a bit of effort. The first one are going to be your contaminated properties. And I've talked about these before, but you probably understand that buying the old chemical plant in town at a tax sale is not the best idea. But there could be something a lot less assuming than that. It could be that empty, vacant corner lot where the community gas station stood up until it was demolished, say 10 or 15 years ago. Unknown to you, the leaking underground gas tanks are still there. That means you'll have to take care of them, or your friends from the EPA will come and give you a visit. Now, with a little bit of research and digging into the county records, you can easily determine if the site has the potential to be contaminated. If it is, the remediation is going to fall on your shoulders if you buy that property, and it could be into the hundreds of thousands of dollars or even the millions of dollars. And depending on the state and just how aggressive they are with citations, fines, and lawsuits and all sorts of other fun stuff, you can really have a battle on your hands. So unless you have very deep pockets, or maybe you own a contamination cleanup company, otherwise it'll probably be best to run from a contaminated property. The next one are the severely dilapidated properties. And these will most likely be properties with an outstanding demolition or condemnation order. Now, depending on the area, the severity of this order and the requirements behind that order can really vary substantially. Certain areas will actually allow you to buy a property on one of those lists, go in there, pull the permits and stuff, clean it up, and they'll take it off that list after the repairs have been done. Other areas won't. They won't do anything. If it's on the demolition list, it will be knocked down. So make sure you check your specific area. So here's where it can really blindside a lot of investors. I have personally driven by properties before that were on a demolition list that looked perfectly fine. It looked like somebody could move in tomorrow. I didn't see anything wrong when I drive by on the road. And then I'll come across a little bit of research that will kind of clue me in on what is happening. That research could say, a section of the roof in the back is completely gone, or the foundation is sagging, or there's an active sinkhole on that property. So be sure to do your research. Just because you can't see it doesn't mean it does not exist. Now, again, it's not to say that you can't make money with those type of properties, because you absolutely can with the right strategy. But as a new investor, you'll likely be biting off more than you can chew when you go after a condemned property or property on the demolition list. If you've ever seen the repair bill for a foundation issue, for example, you will know they are very, very large. So be careful not to put yourself in a bad situation. My advice here is to run from the properties like this until you have the budget, experience, and manpower to take on those challenges. Then the last one are going to be the unbuildable properties. And there are a variety of these that are including properties that are physically or legally inaccessible. We're talking about properties that are perhaps even underwater. There's a lot of those sold at tax sales. Properties that could be described as wetlands or moist lands, maybe lots that are too small to build on, or the strips of land, or the easements, or the green spaces that are designated as no building sites. Now, there's a time and a place and a purpose for investing in those types of properties in some scenarios, But that's a much more advanced strategy than a new investor should take on. Oftentimes what happens is new investors will come across these properties as they're searching their tax sale list, and they'll just hone in on those properties because the competition and the cost is minimal for obvious reasons. So it piques their interest, and then they end up buying something with the plan to just kind of figure out what to do with that property after they purchase it, which is not a good idea. So as a new investor, don't go after the unbuildable stuff. It takes a very specialized strategy. These are the types of properties that become frequent flyers, which is a term that we use in the business, and that term describes the properties that go through a never-ending cycle of tax foreclosure. What happens is they're sold at a tax sale. Somebody buys it. Then they can't sell it. They get tax foreclosed on again. Then it's resold at another tax sale. And this happens time and time again. So if you're a new investor, do yourself a favor and run from the unbuildable properties until you get a hold of these advanced strategies that you can potentially make some money. But right now, just go ahead and run. So there are 3 types of properties that you should probably run from as a new investor: contaminated, dilapidated, and the unbuildable properties. Now, obviously, there are many classifications and many subcategories to each one of these. There's a number of others to watch out for in addition to those 3, but hopefully this video has opened up your eyes to some properties that could cause some huge issues and a lot of aggravation for yourself. If you enjoyed this video, please do me a favor, click on that thumbs up button, subscribe to our channel, that way you don't miss out on future training videos, and also feel free to browse on the 600 plus tax sale training videos that we have for you right here on the Tax Sale Academy's YouTube channel. And for more information on tax sale investing, head on over to my website at taxsaleacademy.com. When you're there, I'll give you my free book, the Tax Sale Playbook. All you have to do is cover the shipping cost, which is very, very nominal, less than $5 inside the United States, to get it from our warehouse to your front. We're actually going to send you a physical book, not an ebook or anything like that. You actually get to hold this and read through it. It's a phenomenal way to start your tax sale career. And then by all means, if you're ready to dive all in and take the step-by-step training that we offer, the more advanced stuff, go to that same website, taxsaleacademy.com, click on join, and become a member of the Tax Sale Academy. Have a wonderful day. Take care. Bye-bye.